Somewhat linked to the price to book ratio is often the term called return on equity is used, and often the two are used together. And return on equity is the return that a company is able to generate on the book value of its equity, and it's defined numerically as being the net income or the earnings of the company divided by the book value of the equity from the balance sheet. So it's the return that the company can generate as measured by net income or earnings on the equity. And why is this sometimes used in relation to the price to book value? Well, the price to book value divides the price of the company's shares by the book value per share. So it looks at how much one has to pay for a certain amount of book value of equity. And by taking this in conjunction with the return on equity, one could, for example, come to the conclusion that a certain company has a low price to book value in relation to the return that it's generating on that book value. So a company might be using the book value, might have the book value of its equity generating a very, very good return as measured by net income, and nonetheless be trading at a very low price to book. Whereas if a company that is trading at a very low price to book that isn't generating a very good return on equity, that might make sense, and there might not be any reason to look at the company further. Now again, price doesn't capture the debt of the company. The book value is a balance sheet measure, and most importantly, the net income, as we've seen, it has a number of flaws in terms of capturing the overall operations of the company, least of which is not that the fact that we're only looking at 1 year of earnings to get to the return on equity number, and it's affected by depreciation, by the interest that the company has to pay, and by the tax policies, and by depreciation policy. But that is, the return on equity is used in conjunction very often with the price to book value, price to book ratio, in order to assess whether a company that has a low price to book value, for example, low price to book ratio, is generating a very good return on that book value, or whether it's not, or whether a company that's very expensive on a price to book value is generating a correspondingly, or one would hope for would be a high return on equity or not. And again, in the case of the return on equity, we're only looking at 1 year of earnings, and so we have to take all of this with a grain of salt. But that's why the two are related, and they come together because both look at the book value of equity and work from that, one in terms of price and one in terms of return.